And welcome to another Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to create and preserve more wealth, exit highly appreciated assets, defer millions of dollars of capital gains tax, maybe even eliminate some estate tax, maybe even save a 1031 exchange, a lot of different stuff. But we're here to help you make what's complex simple and what's possible. And each and every episode, we're joined by some of the best real estate, financial, wealth, and business minds in the world, where they share their ideas and deal stories and their secrets, so we can all level up and create and preserve more wealth and help others do the same. My name is Brett Swarts, for those who don't know me, and I'm founder of Capital Gains Tax Solutions, and I'll be your host today. And each and every episode, again, we're joined by some of the best in the world, and today's no exception. In fact, I am excited for our next guest. He is out of the great state of Colorado, and he formed Pine Financial Group in 2008 after leaving a small mortgage company as a senior loan officer for residential lending, and he has a degree in finance, which he obtained after serving 4 years in the U.S. Army. Thank you for your service. He started out in banking, working at First Bank and lending department while in school, and then he started his first real estate investment company, which is still active today. And he also spent a couple of years in Wall Street working as a mortgage bond analyst before leaving there and to go to real estate investors full time. He and his company has closed over 2,000 transactions as a buyer, seller, or private money lender. And he and his company have access to over 130 million in private equity, and the business continues to see strong growth and so much more. Please welcome to the show with me, Kevin Amolsch. Kevin, how are we doing?
Brad, it's so good to be here, man. I'm excited to be on the show and provide some value to your listeners.
100%. And for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah, for sure. I got started pretty young. I was, as you mentioned, I was just getting out of the Army, and I had a little bit of a savings account because, look, when you're in the Army, you don't make very much, but you don't need to spend it either. They take care of everything. So I started learning, like, what can I do to invest this savings account? And everything I was reading pointed to real estate. So I bought my first house when I got out. I was just turning 21 at the time. Lived there for a couple of years, moved out of it, kept it as a rental. So there I was, 23-year-old little punk kid with a rental property. And what I learned was, look, you have tax benefits, which sounds like you talk a lot about on your show here. You got the appreciation, you got the cash flow. My tenant was paying off my mortgage for me. I was like, this is it. This is what's going to build my wealth. So I really started focusing in on real estate as an investment and into a career. And I started buying a house or two houses a month. And I was doing that while in school and working a part-time job. And I just really fell in love with the financing side of real estate and started raising private capital. Did that in 2006, right leading up to the crash of '08. And then as the crash sunk in, my partner and I separated, and I started Pine Financial. So started Pine Financial in 2008. And so a little over 15 years, and I'm loving every day.
Amazing, Kevin. If you want to learn more about Kevin Amolsch, you can go to pinefinancialgroup.com. It's pinefinancialgroup.com. Kevin, before we jump into the show, which is understanding how to make passive returns from debt, I want to take one other step back. And I believe you've all been given certain gifts in this life, and these gifts can be given to be a blessing and help to others. I'm curious, what was that? What do you feel like that one superpower or gift that you believe you were given, and how does that help how you help and bless people today?
Oh my gosh, what a challenging question right out of the gate here, Brett. I think my superpower is just being able to help people, motivate them, and inspire them to build the wealth that they deserve. So I really want to help people make money, and this business is perfect for it because I have passive investors that invest with me, and I give them a nice steady return, and then I loan that money out to real estate developers. So think about your fix and flippers. They're out there making neighborhoods better, and I'm able to provide that value and help them make money as well. And I just kind of get sandwiched in between the two and make a pretty decent living doing it.
I absolutely love it. So let's dive right into that exact topic, which is understanding how to make passive returns from debt. So Kevin, what is the number one secret to doing just that?
Well, I think it's important to understand the difference between equity and debt. So equity is when you're an owner of the property. If we're going to stick to real estate for this example. So it's great because you can hit much higher returns, but the downside is you're going along for the ride. So if the property does really well, you'll do well. If it doesn't do so well, which is actually happening more frequently than we like right now in this environment, then you're going to participate in that downside as well. The debt side, very stable, very steady. You don't get the big giant returns that a lot of people are chasing, so you'll have to forego that, but it's very secure. and stable. The debt gets paid back first. So if there's ever a problem, that's the position you want to be in.
Got it. So we're talking about de-risking your investments and be able to have steady and stable and secure cash flow versus the ownership, which you can have more upside but more downside, and you're seeing more deals that are coming, on the downside, right? Let's face it, the market was a bull market run for many years. So that's the number one secret. What would you say the number two secret is to understanding how to make passive returns in debt?
Well, I think you need to find the right projects to be investing in. And that's going to be equally important whether you're doing equity or debt. So on the debt side, you are in a secure position, you are in a safer position, but you still want to be working with good operators, people who know what they're doing, for example, so they can get through the project. Like everything we do is value add. So we're taking dilapidated properties and we're making them nice, whether it's commercial or residential. We're fixing and flipping, we're repositioning, we're doing conversions, like big box stores go out of business, like a Safeway, for example, and it's hard to find a new tenant for that. So we're helping our clients divide that up, so repurpose it and use it. So I think the second secret here is really making sure that you're getting into solid projects with solid operators.
Okay, got it. So making sure you're in solid operation, solid project, right? So make sure you're not hopefully losing money, right? When you're loaning money to these folks. Okay. What's the number three secret to understanding how to make a passive returns from debt?
Oh, I don't know. How many secrets are there? Let me think about what the third secret is here. Yeah, I think it's going to be the servicing of the debt. So once you find a good project, a good operating, do your full underwriting, and we could talk more about how to stay safe if you'd like on the underwriting side before you actually wire your money in. But once the loan is originated, you have to do a good job of servicing that. For example, there are times where, like in a fix and flip loan, where you need to issue construction draws. You want to make sure that that project is actually working its way to the completion point. So when they issue a draw request and they want some money for the construction, you need to manage that well. So are you doing your inspection? Are you making sure that they're actually putting the money into the correct property? Are they pulling permits and closing permits out? All of that stuff is important to keep your money safe.
Got it. Yeah, make sure they're doing what you say they're doing, right? Versus just spending the money in Vegas on the Super Bowl, betting on the Niners to lose, which is a brutal loss yesterday, by the way, for the Niner fans out there. But okay, so servicing the debt, making sure that the money is being properly allocated to what it was lent for. You mentioned right before that finding the good projects to be into, but also underwriting those properly. Do you want to touch more on that because you kind of mentioned it before?
Yeah, so I think the underwriting, there's 2 points here, and I think people miss this because I've alluded several times to a good operator, a good owner, the person that's actually signing on the debt. And I do that because most private money lenders or debt investors focus way more on the project itself, and for good reason, because that's what's going to pay you back. But I really think it's important to look at both. So on the property side, are you getting a good valuation? So for us, we like to get full appraisals on the properties, and we want a third-party opinion, a professional opinion on that value once the property's all fixed up. And then we're going to keep our loan at 65, maybe 70% of that value. So if there is a default, which obviously we don't want, but if there is a default, like a payment default, for example, can we repossess the asset and get our money back? That's what keeps us safe. So I would say if you're underwriting it, make sure you understand the valuation of the property and that you're going to keep a low loan to value ratio. But some things that trip people up are insurance, for example. If you get the wrong insurance policy and there's a vacancy clause in that policy, which is very common, then you won't have any insurance at all because the property is going to be vacant for the entirety of the ownership if it's a fix and flip, right? No one ever moves in. So just make sure you have the right insurance policy in place would be another piece of advice there.
Excellent. And by the way, you can learn more about Kevin Amolsch. I'm going to pronounce it. I'm going to spell that for you in case you're not watching this on YouTube, but you should watch it on YouTube if you haven't, because we have a YouTube channel. You can go to Capital Gains Tax Solutions. You can search that on YouTube. It's AMOLSCH. You can also just go to pinefinancialgroup.com, pine, like the tree, pinefinancialgroup.com. So Kevin, let's talk about returns for investors, right? If someone wants to invest alongside Pine Financial Group, talk about the interest rate talk about the returns, talk about the lockup period, and walk us through maybe the track record with performance with Pine Financial Group.
Yeah, that's fantastic. So we're on to our 6th fund. So we get real creative with our namings. It's PFG for Pine Financial Group Fund 6. So that's the most recent one. We've been doing this, as you know, for 15 years. I started the first fund in 2009. So after 1 year in business, we decided to create the fund. And the good thing about a fund over individual notes, which we could offer both, the good thing about a fund is you're diversified. There is liquidity. And a much smaller investment amount. So I'll give you an example. In Denver, our average loan size is getting close to $700,000 just because the projects that are successful right now in this environment are the higher end projects. So we have a high loan amount, which is hard for some people to get involved in this business if you're just doing individual originations or individual note purchases. So investing in a fund, that's what creates the ease of entry, creates the liquidity, and creates a diversification. So we have 2 funds that we could bring money into now. One of them, Fund 5, is for non-accredited and accredited investors, mostly non-accredited because it's a Reg A, which is a public offering qualified by the Securities and Exchange Commission. So we're allowed to publicly advertise and accept non-accredited investors. Very rare. The other one, Fund 6, which is our most recent one, is for accredited investors only. The difference here is they both pay a flat 8% return, and the distributions are every month. So that creates some income, or you could reinvest it back into the fund and benefit from compound interest. The difference here is Fund 6 also pays out a little profit distribution. So any money that the fund makes over a year's time, we split with the investors, 70% going to the investor, 30% coming to us for managing the fund. So those are the 2 separate funds. And then individual notes, we do sell those on occasion as well.
Okay, excellent. So it sounds like there's Fund 5 and 6. One's non-accredited and accredited. The other one is just accredited, paying an 8% return, monthly distributions, except Fund 6 has a 70-30 profit share split at the end of the year. You mentioned a little bit of liquidity. So let's say someone put $1 million into Fund 6 and they're getting that 8%. Would that be, in 1 year, would that be $80,000 exactly? Walk through that number. And then number 2, let's say they wanted to get out, in 6 months, would that mean they'd only get 4% in that year? Talk a little bit about how that might look, just practically speaking.
Yeah, let's talk about that lockup first. So in Fund 5, there's no lockup. So if you think you might need the money, then you can get it back at any time. With the exception of we're not a bank. We don't have unlimited resources. So we do take the money in and put it out into loans secured against real estate. So we may need to wait for a loan or 2 loans to pay off to free up the capital to return the money. So there's a little delay there. Fund 6 is similar, except for we do a 9-month lockup on that one. And this is the first fund we've ever had any lockup period at all. But what we were finding is in Fund 5, we have a minimum investment of only $10,000. So we have $10,000 investors trying to use it as a checking account or regular savings account like a money market, and they would put money in and then 2 months later pull it out. And it just became such a administrative headache for us. So we decided to put that 9-month lockup on Fund 6. Now, to answer your question about the rates, yes, if you put $1 million in, you would have an 8% return. So over a year, it'd be 80,000, unless you compound interest, right? Because if we distribute 8% in month 1 and you don't take that money out, you leave it in, then you're going to be earning 8% on the million plus the distribution in month 1. And then every month you'll just earn interest on interest. So it'd actually be a little higher than the 80,000 at the end of the year if you do the compound. And then of course the profit share is there as well. So whatever the profit we make, you would get 70% of that. We're targeting, and this is based on 15 years of experience, we think that the returns for the year will be between 9 and 10%.
Excellent. Hey, fantastic. We're talking with Kevin Amolsch and pinefinancialgroup.com. We're understanding how to make passive returns from debt. And Kevin's out of the Colorado area, and they're making loans in Colorado, Minnesota, Washington, D.C., and Wisconsin, which is interesting for those particular areas. Kevin, I want to shift a little bit here. All good, by the way, those areas, and I'm sure there's a reason for that. Maybe you can mention that here in a minute. But I'm curious about capital, right? And maybe even the biggest frustration with the 1031 exchange, like you mentioned, equity versus debt. And a 1031 exchange is a continuity strategy where you have to trade ownership for ownership. In other words, equity for another equity placement. And it doesn't let you get on that debt side of things. But talk about the ability if someone could sell a business or real estate or crypto and exit multiple millions of dollars and then still defer the tax and be able to invest passively into like a debt instrument that has some liquidity built in and has much less risk than a lot of these deals that people have been overpaying for the last couple of years. What would that mean for a group like yourself that's been in the business for 15 years?
Oh my gosh, Brett, this is such a challenging and interesting question. I've been trying to crack this nut for at least a decade. So the 1031 obviously is super powerful. One of the reasons a lot of investors like investing in real estate, right? The problem is, as you mentioned, it has to be a like-kind exchange, and going from equity to debt isn't that. So we haven't been able to figure out how to defer taxes when you exit one investment into a debt fund. So I don't have an answer, but I would love to know your opinion on how somebody would be able to do that.
Yeah, you want to break it down right now? We can go into to building mode here with strategy. It's called Building a Capital Gains Tax Exit Plan. If people want to get started, you can go to capitalgainstaxsolutions.com. So this is how it works. Step number one, Kevin, you don't use a 1031 exchange, right? Because the first thing is 1031 exchange only works for like-kind investment real estate. It doesn't work for moving real estate equity into debt. That's not like kind. Debt is different than equity, right? They're completely separate. So you need to use a debt strategy. We found the one being an installment sale, but you couple that with a trust. We call it a deferred sales trust that allows you to exit the assets, defer the tax, and then turn around and invest it into any asset of any kind at any time. In fact, we just did, for example, a $13 million exit in San Diego for some clients who really felt like the market was turning. And this one's about 2 years ago. And they used the deferred sales trust to not only exit, pay off their debt, but they put the majority into a debt fund, very similar to yours, all tax deferred, and they deferred the tax. And so this trust is formed, and they exchange and they sell their asset. Instead of exchanging it into a qualified intermediary, they actually sell it to the trust and they get a promissory note back. It's known as seller carryback. And they have it's typically structured at 6 to 8 to 9%. But from there, the funds can go into any investment. It can go into T-bills, it can go into real estate, passive or active, it can go into development projects, go into business ventures. But the number one we've really loved is debt funds like yours, because of the security we believe with real estate still being the foundation, but being that first position in case things go south. So it's called a deferred sales trust. Any thoughts or questions on that so far?
Gosh, you definitely caught my interest here because this sounds amazing. I'm going to definitely research this more after, and I'm sure we're going to have some conversations after this recording here. But no, I don't necessarily have any questions other than you said sell it to a trust. So I guess you transfer ownership into the trust, and the trust signs a promissory note, it makes payments, and then to actually free up the cash to make the investment into the debt fund, I guess you would have to sell the asset out of the trust.
You got it. Yeah. So it's three parties, right? So in a traditional installment sale, there's two parties where you're just financing the buyer. But then the challenge is all of the equity is tied to the old asset, which defeats the purpose, right? So we take the foundation of a seller carryback and we say, hey, go find a buyer. Like we just did another, in fact, Friday it closed, right? It was a $2.2 million exit in North Dakota. Okay. And they're selling a farm. They have basically next to zero basis. And so instead of no debt, and so instead of financing the buyer came with the 2.2 million of cash. The trust was right in between. The seller first sells to the trust on an installment. Okay. Over here, actually. And that installment is a $2.2 million promissory note. Right. And then the trust immediately sells it to the buyer. So the cash gets infused into the trust. And so the trust bought it for 2.2, sold it for 2.2. So there's no gain, right? And so that's good. The buyer takes title, they're gone, and the seller's left with the promissory note. But now the funds are sitting in a liquid, typically Charles Schwab. And now it can be diversified, dollar cost averaged, right? There's no timing restriction, no 45-day 180 shotgun wedding, no like-kind replacement requirement, or even worse in the 1031 exchange, the equal or greater debt replacement requirement, right? That's where people really get hurt because they have cash flow, tax flow, and debt flow, and it gets all out of whack. They end up doubling down on their debt and or going more by interest rate. I mean, on that, maybe the same amount of debt, but higher interest rate, inversed cap rates to equity or to debt. In other words, the debt interest rate is higher than the interest rate. That's not good, or the cap rate. That's not good. You want the opposite to happen. And so this solves all of those challenges. You can get your debt flow, your tax flow, and your cash flow all aligned. And when you do that, you get time to be your friend, right? Versus your enemy, and you get diversification and liquidity to be your friend. Again, you can learn more about it by going to capitalgainstaxsolutions.com. Any thoughts, questions on that, Kevin?
No, I think it's a genius. I don't know how I haven't come across this. I've been doing real estate investing for over 20 years and haven't come across this. So super fascinated.
Yeah, absolutely. And by the way, we wrote a book on it too, in case people are wondering. It's called Building a Capital Gains Tax Exit Plan. And the same thing was true, Kevin. I sat at Marcus and Millichap thinking we were the Navy SEALs of investment brokerage, doing 1031 exchanges before the 08 crash. Then the market hit the fan, and we said there's got to be a better way from these shotgun wedding 1031s. And that's when we learned about the deferred sales trust. And what's funny, it's called a DST, and a lot of people get confused thinking they've already heard of it because they think it's a Delaware statutory trust when it's not. A Delaware statutory trust is just another form of a 1031 exchange, whereas the deferred sales trust is not a 1031. Therefore, it doesn't have to follow any of those rules. And it's an installment sale known as IRC 453 with the trust. And that's the secret here once you understand that. Anyways, people can learn more. You can buy the book on Amazon and Building a Capital Gains Tax Exit Plan, or go to capitalgainstaxsolutions.com. Okay, moving right along. I want to jump back into the show now. Thanks for that little plug here for my stuff as well.
That's great.
So I want to talk about the ability to foreclose. These are first positions, I imagine. There's probably hopefully no seconds allowed, and you're probably doing a lot of repeat business. You're also probably seeing an influx of business because a lot of banks are getting out, Kevin, right? For a lot of reasons, and you're the one that can stay in. Are you finding that you can maybe increase some of your interest rates? Are you still just staying the same? Like, what's your overall feeling as interest rates increase? Are you able to get a little bit more margin for the investor?
Yeah, that's a great question. I get that question a lot. So we have just crept up the rates on our new construction projects because those take so long, and we're able to do the fix and flip so fast, right? So we make the majority of our profit from fees that we charge our borrower. We never charge an investor, a passive investor, any fees at all. So we charge our borrower fee to give them a loan, and then so the more quickly we could turn that money, the more money we make. And we've found that the construction takes a while. But to answer your question specifically about raising rates, we have not done that on our bread and butter fix and flip loans. And the reason for that is I really like the whole platter to choose from. I want all that demand. I want to be able to be very picky with what loans we're going to accept, especially in a shaky environment. So we just decided to tighten underwriting guidelines instead of readjusting our pricing. And I think our investors appreciate that because now we have a really strong, solid portfolio.
Yeah, I think that's great. That's fantastic. I love the way you approach that. And it sounds like you have an excellent model here and a tons of experience. And I like that you've been in the business for 15 years, right? It's key because you've been through some of the shaky times there when you got started. So that being said, do you feel like there's going to be influx of opportunities? I know office is like the debt is a disaster there. So don't even talk about that. Let's just talk about mobile home park, multifamily, maybe, as the main two. What's your sense on like this 2024? Is it the best buying opportunity we're going to see in a lot of years? Do you feel like there's more distress coming? Like, what's your take on just that whole market? And by the way, are you seeing distress from the people that you're loaning the money to?
Yeah, I'm glad that you pointed out those couple of asset classes there, and you didn't mention housing. And I like that because housing is not really at risk. We all know that there's an inventory problem, and there's just not enough of it. So we're continuing to see property appreciation even in a challenging high interest rate environment. Now, you said mobile home parks and you said multifamily. We have seen a softening in those areas already. And do I think it might continue? I do. And the reason for that is, for some reason, especially with multifamily, there's just an appetite at the banks for this stuff. Banks do want to make multifamily loans. And then you also have your Fannie Mae money that qualifies for multifamily, which it doesn't qualify for any other asset class in the commercial world. So that amount of liquidity has held cap rates down. So obviously a lower cap rate means a higher valuation. And to the point, the negative leverage, which you brought up just a few minutes ago, we are still seeing negative leverage in the multifamily space. Negative leverage, for those that don't understand it, means the cap rate is lower than the money you're borrowing. So the more money you put into a project, the higher your cash on cash return is. So it's very strange and it's not normal. Normally you want to see your debt rates much lower than your cap rates. So I go into a little detail there, Brett, because I think if interest rates stay high, which we do think there'll be some softening, but it's still going to stay high. I think cap rates have to come up to at least match or go above the debt rates, and that's going to bring valuations down. So that will create some opportunities, in my opinion, and especially some of the larger Class A stuff where we have hedge funds just handing the keys over, right? That obviously is happening in office, but it's happening in multifamily as well.
Yeah, it's interesting to see. Again, that's another reason why we love the deferred sales trust, because we weren't overpaying these last couple of years in real estate doing the 1031s. We were actually paying off our debt, getting diversified, getting out, and waiting mostly in debt instruments like the ones that you have for a time like this to buy. But I'm just waiting to see where those deals would be done off market. Those would be under the, bringing JV partners, a lot of capital that's maybe infusing. I'm seeing the capital calls with some of the deals out there. So, okay, that's great. That being said, hey, we're running out of time. Are you ready for the lightning round?
Let's do it.
All right. Knowing what you know now, Kevin, if you go back to your 25-year-old self, what's the one golden nugget to make sure to tell yourself to do?
I would just do what I did. I would ready, fire, aim. I think you got to take action. Even if you're going to make a mistake, you're going to make the mistake. If you don't, you're not going to be successful. So take action. Absolutely.
Question number 2, what are you most curious about right now?
Well, your deferred sales trust. That's what I'm most curious about right now.
Absolutely. Thank you so much for that. Question number 3, what would you say is the number one book you've recommended or gifted the most in the past year?
Well, it's definitely Rich Dad, Poor Dad, but I know a lot of your guests probably say that one. So I'm really liking Traction to Scale a Business.
Excellent. Question number 3 or 4 here. One of the 3, I think it's 3 or 4. The number one way you're using ChatGPT.
I just went through a course with my EO group, Entrepreneurs Organization. It's like a leadership group about this because I'm not good at it at all. But I have a goal to visit all 50 states by the time I'm 50. And I wanted to create a checklist, but I didn't want to type them all out. So I asked ChatGPT to do it and it printed it all out for me.
Okay, awesome. I love it. You got to get started somewhere. Next question, Kevin. Number one leadership quote or theme that you strive to live by.
I think you have to, your company lives and dies by the values. So I think no matter what, as a leader of an organization, you have to be involved in the values of the company.
Excellent. Last question, Kevin. After helping all the people you've helped building passive income and de-risking themselves from like the stock market or even traditional 1031 exchanges, how do you stay centered in your values? What's the number one practice you practice, and also stay charged up to reach for even higher heights?
Oh, it's definitely your morning routine. I think all successful people have a pretty strict morning routine. So, the getting up, the working out, the making the bed, the reading, whatever the routine is, I think that's a superpower.
I couldn't agree with you more, but I'm adding cold plunge to mine now, right? So I it's called the pull, and I don't actually haven't bought the unit yet. I'm going to be buying a unit. I have a good friend to be client here soon who's got a company that does this kind of thing. But the point is, I've been jumping in the cold water, and it feels great. I work out in the morning, like 5 minutes of it. Like it's legit. Like it's really cool. Add that to the morning routine if you can. That being said, Kevin, I want to thank you for being on the show. I want to thank you for sharing your knowledge and insight on unlocking passive investing, creative financing, and funding strategies, and really building wealth on making passive returns from debt. So this has really been great. I want to encourage you to keep using your gifts of helping, motivating, and inspiring people to make money and to unlock some freedom in that way. For our listeners who want to get in touch with you, would you mind one last time, what's the best place for them to find you?
Yeah, best place is pinefinancialgroup.com. It's pinefinancialgroup.com.
Excellent. Thanks, Kevin. And thank you, all of our listeners, for listening to another episode of the Capital Gains Tax Solutions Podcast. Again, we believe most high net worth individuals and those who help them, they struggle sometimes with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust can be the Netflix way of exit planning versus the old blockbuster 1031 exchange. Don't get caught in a 1031 exchange overpaying for a property or going into an investment class that doesn't suit your risk tolerance and your time horizon. Consider the deferred sales trust today. You can get started. Go to capitalgainstaxsolutions.com. Also, check out the brand new Best 1031 Exit Plan. This is a great opportunity for you to learn about the deferred sales trust. It's a short course that'll break down the deferred sales trust, Delaware statute trust, 1031 exchange, as well give you the service to do a 1031. And in case it fails, you can go into the deferred sales trust as the backup plan. In fact, friends don't let friends 1031 without having a backup plan. Go to experttaxsecrets.com to get started on the best 1031 exit plan today. And that being said, please rate, review, subscribe. Please like the show, leave a comment, anything to add some love to the algorithm so we're higher on YouTube and on the Apple Podcast. We appreciate everyone out there, and we'll talk